Okay, so in this video, we're going to be giving a broad update of the current state of the US stock market. We're going to be checking in on my portfolio, see how things are doing in comparison to the broader stock market. And then finally, I want to share some portfolio setups that I've been experimenting with, and I wanted to get your opinion on them. So let's jump straight into this. Currently, the S&P 500 is up 1.22%, the Dow Jones up almost 1%, and the Nasdaq 1.7%. So clearly a pretty positive day in the market, especially relative to the past couple of weeks. Now, unfortunately, not everything as good as we can see by some of the headlines here. Optimism fades among individual investors. We can see the chart here, and this is the bullish sentiment or expectations that stock prices will rise over the next 6 months, and it fell to 18.1%. The bearish sentiment, by contrast, rose to 53.3%, highest level since the June lows. And there's lots of reasons for this. One of the main ones is the European Central Bank just raised its key rate by 75 basis points. And here in the US, the stocks have been volatile recently because expectations of yet another 75 basis point rate hike that grew on Wall Street this month. The Fed chair said again that he is strongly committed to bringing down inflation, which is great long term, but that does mean that right now, stock prices are going to suffer. In fact, right here, they elaborate a bit more. So it says the case for the ongoing bear market is the Fed will continue to tighten monetary policy, withdraw liquidity from the market, and cause tailspin for equities. But this week's market recovery has shown there is continued resilience in the economy, bolstered by favorable economic reports. And this has been a bright spot. The underlying economy continues to be rather strong, at least here in the US. And on this point, recently, the Treasury Secretary, Janet Yellen, said that the White House's policies have rescued the US economy. So essentially, she gave a speech on how the Biden administration's economic policies have a positive impact on the economy. Now, of course, you can take this as real or a political move. It's really up to you. But in particular, she does highlight the so-called modern supply-side economics framework that is being implemented currently. And she's quoted as saying, "And now with the economy at full employment, we are uniquely suited for a supply-side expansion that delivers sustainable growth and reduces inequality." But regardless of this, looking at the hard data of the current state of the stock market, we are somewhat overvalued according to most metrics like the price-earnings ratio. Here's a little chart, and it says that as of September 2nd, we are at 43% above the historical norm. Although according to some metrics like the mean reversion, which I'm a big fan of, we are currently just barely fairly valued at 32% above the trend line, which is within one standard deviation. So my takeaway from all this is that the stock market really isn't that cheap yet. The underlying economy is doing okay even in the face of high inflation, and personally, I think inflation within a year will come down to more reasonable levels. But with all that in mind, I don't think the stock market's really going to do well until interest rates begin to come back down again, and so far, that's really not in the cards. Okay, so taking a look at my portfolio today, it is up 1.3%, and if we go back to the market, it is up 1.1%, so we're doing slightly better than the market. The past 5 days, the market is up 1.1%, and the past week in my portfolio, 3.3%. But if we begin to zoom out to longer time frames, like 1 month, I am down 2.4%, and the market is down only 1.5%. So my takeaway here is that my portfolio setup, even though this wasn't my goal, is more volatile than the general market. So it both goes down more and recovers faster than the overall market, although not by a huge margin. And we can see that the different sections of my portfolio do behave differently. And speaking of how I set up and divide my portfolio, I've been thinking a lot about this lately because eventually I do want to make a slight change in the way that I at least organize my holdings. And this is kind of my current thought process. This is how I have it currently set up. I have my main holding, which is the S&P 500 with covered calls on it. It's great, it's systematic, it's passive, it follows the growth of the US stock market, and it generates income along the way, which is especially valuable during sideways markets like we currently find ourselves in. And then in addition to that, I have income assets like JEPI, and then growth assets like BST. Now, coming back to my future plans, I'm going to keep it mostly the same, but I do want to increase the efficiency, reduce redundancy, and really focus on the high quality names. So here are 3 separate portfolio layouts that I was testing. The first one here is XYLG, which again is the S&P 500 with covered calls on it. And that's going to remain consistent in all of my portfolios because that is my single favorite holding. So in addition to that holding, in this first portfolio, I kept it very simple and I just have SCHD and VONG, which is a dividend and growth ETF respectively, with no covered calls. And then if I draw your attention to the third portfolio, is the exact same, but I have DIVO and BST as my dividend and growth ETF, and they both use covered calls. So I want to see how they compare. And the second portfolio is all of the above. So if you come down here to the performance, the blue line is portfolio 1, the second is portfolio 2, and the third is portfolio 3. And this is how the performance is. And as expected, portfolio 1 with the more equity exposure performed the best in terms of price appreciation. But if we keep scrolling down on this data page, we can see that the income is the complete opposite. So portfolio 1 has the least, portfolio 3 has the most, and the second one is somewhere in the middle. So let me know in the comments down below, which one of these portfolio setups do you think has the advantage? Personally, I think portfolio 2 being right down the middle, both in terms of capital appreciation and income generation, is ideal, although I'm not a big fan of all the complexity and overlap. Now, really quick, I do want to address that JEPI, one of the most popular ETFs that I'm sure a lot of you guys love, is missing from all of these portfolios. And that's because JEPI is hard to classify. It's not really a dividend or a growth ETF. In fact, it most closely goes against XYLG. And if we do a direct comparison of XYLG and JEPI, we can see the relative performance right here with XYLG in blue and JEPI in red. And the thing I noticed here is that the performance, at least in the short term, is very similar as expected. They're both based off of the S&P 500. They use covered calls. But the biggest differentiating factor is that XYLG is more volatile. So it both goes up and down more. So finally, just for fun, I took that second portfolio, which I was the biggest fan of personally, and I took some allocation away from XYLG and I shared it with JEPI. So this is how I integrated JEPI into the previous portfolios. And here's the impact that adding JEPI made to the performance. Of course, it's minimal, it's not a huge difference, but we're going to see that portfolio 2 with JEPI did lag behind slightly during the good times, but now in the bad times, it is holding up a little bit better. And in terms of the income generation, it does help generate slightly more income. Yeah, so leave a comment down below on what you think of these portfolio setups, what ETFs are your favorite, and just give me your thoughts. I'll be reading the comments, but that's going to be the end of the video. Hope you guys enjoyed. If you did and you're still watching, I appreciate a like. Go ahead and subscribe for future content, and I'll see you guys in the next one.